Wednesday, and welcome to MyStockScanner Live. We are halfway through the week, and the market is moving fast. Let's scan the headlines and put today's stocks through the three-point playbook. And these two guys are ready to do that, Liam Flavel and Hans Henrik Nielsen. The stocks will, as always, be measured on quality, upside, and timing. And Liam and Hans Henrik, earnings season started. JP Morgan, Johnson and Johnson, Wells Fargo, Goldman Sachs, BlackRock, and Citi were all yesterday's news. Did anything stand out to the two of you on numbers from those guys?
They're making a shed load of money, aren't they?
True, true.
Well, what we said the other day was we expected some very, very solid numbers from them because interest rates are still high. They are making a ton of money. There's no recession, which normally, if there is a recession, makes it so that they lose a lot of money on people not being able to pay off loans. So it's basically perfect for them right now, and that is what showed in the number. JP Morgan had a bit of a drag down due to a big bankruptcy, but otherwise everything looked good.
Yeah, they basically just took a sip of water and then went on from there, and still, as you say, make a ton of money. There's no doubt. On the show today, we will be talking about the Powell spoke. What was said and what was said between the lines. We'll try to sort that out. The trade war rolls on. We are basically throwing soybeans, cooking oil, kitchen cabinets, softwood, hardwood, and the kitchen sink is thrown between the US and, and China. And on our little show, we'll talk about Walmart's ASML. We'll talk ThyssenKrupp, Ericsson, and we are catching up on Netcompany because you guys out there, you asked us to in our Tuesday poll. And speaking of that, you can ask us, then use our email FOMO@mystockscanner.com if you have any questions. And if you stick around, I'll tell you the number of the day. I promise to sprinkle a little dust here to the tune of 17.8%. I promise to tell the story behind that number at the end of the show. And trust me, there is a silver lining. But news, trade war. And I said, Hans and Liam, that we are throwing basically the kitchen sink at it at the moment. What's going on? We're talking cooking oil all of a sudden, and we're not even a food program.
It's a slippery slope when you start talking about cooking oil, isn't it?
All right, if we should have some serious comments about it, it's a lot of it's a mixed bag because the cooking oil comes because of this. China is not buying any soybeans from US, and that is hurting the farmers insanely. We have said for a while, keep away from stocks that are related to farming, John Deere and so on, because they might be hard hit. Trump needs to show his farmers that even though they voted for him, it was not intentionally that he's bankrupting them all. So he's coming up with this cooking oil, which is about $1 billion a year. It's basically nothing, but it made the market a bit nervous. Then there is the kitchen, the cupboards and furniture and all that stuff, and that is an extra tariff Trump decided some weeks back or a month back, where there is some 10% on wood, there is 25%, I think it is, on kitchen furniture and normal furniture, and there's some more coming around New Year. So it's all to get some manufacturing jump back, and the latest number shows that is not happening.
And the reason why I mentioned softwood and hardwood, and you lectured us this morning when we were meeting up before the show, Hans Henrik, and that is that softwood is what they do in America.
In
Canada.
They're spending a lot of wood.
In America.
They're spending a lot of wood building houses, and that is mainly softwood, and that is mainly coming from Canada. And that is they put a tariff on that now, meaning building houses become more expensive. Trump has been out saying, doesn't matter, we have plenty of forest, plenty of wood in US, but that is mainly what is called hardwood, which is not as good to build with, meaning that either the houses are getting worse or they still have to import softwood from Canada, which they do, and that will just make the building more expensive.
See, we went from a cooking class until a do-it-yourself class right now. we are everything basically on this show, MyStockScanner Live. But let's get to some real macroeconomic numbers here, because Fed Chair Powell was out speaking yesterday, and as always, his words are really measured on a scale. What did he say and what didn't he say? And he was talking about a beige book, and it's not an equivalent of Fed's Facebook, I think.
No, definitely not. The beige book is something that Fed comes out with. I think it's about every month or so, every 6 weeks, where they measure the temperature on. They are out polling, simply asking people how are you doing on how much interest are there from retailers, how much are they're trying to get an idea, where are we? And as far as I can tell, it was actually already released yesterday. But I have one report saying that it's not going to be released this time. So I am not really, I'm a bit confused. I have to dig into this. If the one report is right, then it showed a mixed bag of modest growth and maybe no growth at all. And if the other report is right, it's not even out there. So happy AI internet days.
But let's get into numbers that we can talk about, because Walmart, of course, the biggest retailer in the world, was one of Dow's biggest gainers yesterday, because, well, ta-da, they did a partnership with OpenAI. And ka-ching, right there, Liam.
I think...
We try again. It's one of those days.
Just make sure that we have people online. Okay, sorry guys, I can see you're still online. Liam's internet went out, and he was the one that started the stream apparently. So the stream disappeared. Welcome back, Liam.
I'll come back in. Sorry.
All right.
I think that in that sense, this is why we do live. So we have intermissions like this, but we're talking Walmart, and I know that you taken a look at the stock, and as we said when you couldn't hear us, was that they had their OpenAI moment, and it made the stock jump. But is it investable, Liam?
I would say not basically on this information, but just take it on, is the stock a decent stock in the playbook? And if we move to the playbook on my screen, and I will just come across into there, we can see, let's just reset my value chart and go back to the playbook. We can see that actually Walmart, I mean, it's been a favorite of ours for quite a while. We've had it in the playbook. It's been a stock of the day last year, I think it was, and we actually bought it this year, I seem to remember. Really, really high quality score. Earnings per share is increasing, and the analysts expect it to carry on growing. PEG ratio is quite high. We really prefer it to be below 2.5, something like that. But you can see the analysts are being positive on it at the moment, and the returns are just sort of going up and up. Free cash flow, we normally refer it a little bit lower than that on the price to free cash flow, below 35 or so. But it's a really, really high quality stock. Then we come to the valuation, and that's where sort of we start looking at, is it a stock that we'd actually want to go into? And you look in here, and I'll just adjust these lines so they hit the tops and the bottom of the recent sort of last year or so, and you can see that the stock is pretty much at the top of its channel. So even before yesterday, 5% rise, we might have seen a 5% gain over the next 18 months, and maybe a break even in the worst case scenario. Now, I think I'd personally rather wait until we get closer to the end of the year and then see what the numbers are towards next year, and that's when it can start going up.
If I might add, we are an overall worry we have here, because when stocks like Walmart goes up on AI rumors, then it just reminds us of some scary times before several crashes. We're not predicting a crash now, it's not that, but it's just that when a hype runs and Walmart yells AI and it goes up, then it's not the best of signs.
But guys, if I may, and I'm definitely not the expert here, and we're not recommending stocks. That's not what we do. We analyze them. But the thing is, couldn't Walmart really be a safe haven? Because it is one of those places that Americans shop, and they'll shop there no matter if it's a crisis, whether there's a, yeah, I'm gonna say a bubble, anything. It's just a place that they go.
Yeah, it definitely is. But the thing, the rise yesterday, and we're looking at, is that going to power the stock up a bit more? Do I want to buy something through ChatGPT, or would I rather just go onto the website myself and
And
find
do
it?
you want to buy a stock in a safe haven at a price earning above 40? That is expensive. If we look at the average PE over last 10, 5, 20 years, it has been 32, 28, 21, depending on what you, if you look at the average down below, Liam, there you can see a 3-year average, 5-year average, and so on. It hasn't been at 40 on average at any time. It's at 40 now. Do we really want to buy a Walmart at PE of 40 just because they are shouting AI? I'm not sure.
Let's say that we are not recommended, so we're definitely not saying yes or no, but we find it expensive. Today's earnings have given bump in the stock markets already. We had Louis Vuitton coming out, and they went up by 12%. But we also have Bank of America later, Morgan Stanley, Apple Labs, Rio Tinto, and a lot of others. But one of our favorites, we have to say, ASML, they took, well, not a big bump, even though that their numbers were fine. Liam, you already put it up on the screen right now. What's up with ASML? Isn't that a fantastic stock?
It is a fantastic stock. They're the only company in the world that can make the machines that actually make the chips that we all use in our iPhones, put into AI and PCs, laptops, everything. So they are an absolutely fantastic company. But if you look at this recent rise since the 5th of September, in just over a month, the stock has gone up now 37%, something like that.
And it's up
So,
even more today. I should add here, Liam owes me a really expensive dinner for persuading me not to buy it back at 600 something. That's the most expensive chat we've had this year, Liam.
I actually bought it because I thought we said we were going to buy it. So I'm actually in it and have been in it in one of my portfolios for a while.
Yeah, okay.
But yeah, I mean, basically, the stock is a huge quality stock. We can see green across the board here, quality of 100 for this particular company. And the PEG ratio here, below 2 shows us that there's room for growth in there. And you can see that in the earnings per share growth as well. So there's room to run on the stock definitely over the next year or so. Would we buy it now? It's a little bit close to the top end here. So I would say we'd probably stay away from it right now.
So far, the ASML, if I've taken your hands, let's say a couple of months ago and said, let's go, let's get some Ericsson stock, what would you guys have said?
Well, I prefer my Nokia 3310, so I'm not sure.
But
probably not.
Probably not. But the thing was, it rallied yesterday on the Swedish market to the tune of 18% because of earnings beat and positive guidance. Liam, we missed out, but did we? Or what's the story here?
Not really. I mean, there is some green here. You can see that on the system. Yeah, it is a high quality stock. There is lots of green, but people who sort of regularly sort of watch us and see how we calculate these things, they know what we like is a positive earnings trend going up. And you can see the last couple of years have been a nightmare. Last 4 years actually been a nightmare for Ericsson. Also, even though the analysts are saying that the stock, the earnings per share is going to go up next year or towards the end of this year, they're then saying it'll drop back down again, and that's a pattern that we really, really dislike and we don't like to go into. However, having said that, the analysts have been really bullish on it recently in the last 30 days or so. From a value point of view, we're here. The top of the channels here. So actually the value chart called it yesterday absolutely perfectly. We wouldn't buy here.
That's a quick answer to my question on that. And do you have questions for us? So please remember, write us, FOMO@MyStockScanner.com. One of the things we asked you guys yesterday in all our social media forums was to participate in a little poll. We asked about stocks that were outside the C25, the 25 biggest stocks on the Copenhagen Exchange. You came back with a lot of suggestions. I think that if we poll the 3 polls that we did on social media, I think the most popular ones was Chemometech, Torm, and Netcompany. Nobody suggested Asetek yesterday. Maybe there's a reason for it. It cost under 1 kroner. But today it's up by 15%. So you should have suggested that yesterday. But we're going to focus on Netcompany and take it to our 3-point playbook because that was the one that most people suggested. What are we seeing?
Well, Netcompany is a very interesting company. They have been through, if we just look at the chart, they have been through some serious problems here. I talked to several people that work there that had employer stocks up here, and that was just kept going down. Some of them actually were in it all the way back here. If we can zoom out, it was up around 800, and now it's a lot lower. However, if we look at the playbook, we can see that they have a good quality. Earnings per share is rising upwards. That is what Liam talked about. We do like that. There can be a year or two where it's a bit lower, but we do like that overall nice trend upwards. The PEG ratio, as we talk about often, is showing that there is some good growth comparing to what we are actually paying for it. Revenue is going up. It's overall actually a very nice quality. Free cash flow is going up. Looking at the value chart, let's just get in here. We can see that, just to be fair, we are not saying that it will go up 83%. We can see that the analysts are saying around 16% over the next 1.5 year. And our scenario here suggests, well, it might be a bit lower. We might be down somewhere here, but that still shows us that our bear case is somewhere around -5, -10% in the worst case, and that we have up towards 50-60%. Again, we're not saying it'll go 50-60% up. We're looking at having a small potential drawdown and a large potential profit. And as long as we can do that, we are doing fairly well.
I need to ask you, because what I looked at when we logged into it, it looked better than what it did when we were going out of it, because you ruined everything. I'm not saying that you personally ruined everything, but explain what you did with the graph there, right there. Because the thing is that when people log into our system and they see the picture that they did first, they need to juggle it a little bit, not because those numbers are necessarily wrong.
No, these numbers might actually be right. This is our system that Liam had programmed some different formulas into to try and get an automated estimate. And when we look at this, the lower here, the bear case, that is at a price earning of around 19. We can actually see that has been the bottom several times earlier. So that might be right. Someone might even argue that the top here, saying, when do people think it's expensive, that we might even want to drag that up because it has been selling at more expensive price earnings earlier. What I do like to do is not to be overly optimistic, meaning that you can easily find a stock, fall in love with it, and then just drag these numbers up, and then it shows plus several %. I do like to quote unquote torture the numbers a bit and say, okay, what if it actually becomes a lot worse than I think? Am I still seeing a decent case? And if I'm doing that, I'm even more certain in my investment thesis.
So far, Netcompany, as said, not recommendations, just doing the analyzing bit here. And again, you will have to do your own analysis at the end. Drag around the numbers, see where you're comfortable. It's all about having a strategy and then sticking to it all the time. That's what we do. And on Mondays, we will tell about the 3-point playbook portfolio. That's real investment. That's what you guys are in. And we'll tell how the standing is. We have something every day that we do. On Fridays, it's the face-off. We pit 2 stocks against one another. You have that looking forward to. And then every day, what we do is that we have a number of the day when we broadcast, and it's something that you guys don't know what it is. I tell you, I said in the beginning, they had a silver lining at the end. That should lead you on to something. The number was 17.8%. And If I say it's in regards to silver, okay, it's too tough. I know it's hard, but that's why we try to make people stick around to tell. And I'll tell you what it is. That's the amount of silver, of the entire silver production that goes to investment. 17.8% are used to investment, physical buy and sell silver. 59% are used by the industry. 17.1% is used by jewelry. 4% for silverware, and 2.1% is photography. That's how silver is used around the
If I
world.
might add here, over the last couple of years, we have looked at the numbers and said the production of silver is going down. The usage of silver is going up massively in EVs and green tech. So we have actually, well, predicted that. It's easy to say when you say it over several years, but we have said there's definitely a case for 3, 4, 5x the price of silver. It's up 3x since we started talking about it now. Can it do 2x more? I don't know. Maybe.
There's no doubt there is a look for precious metals all around. And we yesterday looked, if you go check us out on our Facebook page, but also on of course, our homepage, for another mining stock. That's what we do. Tomorrow, when the markets are open, we will have numbers from TSM, Nestle, Charles Schwab, and Interactive Brokers, amongst others. On Friday, it will be American Express and Schlumberger. There's a lot of things coming. And before we go, I promised that we would talk ThyssenKrupp and Hans Henrik. ThyssenKrupp is being, I won't say spun off, but
yes. First of all, I would say the chart I just pulled up here was silver, just so people are not confused. Why did you put something up here?
If that was ThyssenKrupp, we are late.
That would be nice. ThyssenKrupp, many of us know it as one of the large industrial stocks in Europe, but they are spinning off what they call the warship arm. So they are basically building warship along with everything else from steel beams to kitchen accessories. But ThyssenKrupp is taking a small portion of the company and making into a stock of its own. It's like a split that they will still own 51% of this warship thing. It sounds very potent, I would say. And we can buy into that. I think is it from next week, the week after, something like that? It's being listed. We would probably not jump on the warship thing because we don't buy IPOs. We need to figure out what is the pricing and everything. But if you want to get in of some of the warship action, you might want to have a look at simply buying ThyssenKrupp because they still own 51% of this defense stock. Would we want to buy it? Well, just looking at the value chart here, I can say probably not. Again, I know the potential looks good, but there are huge holes in their earnings. Not something we wanted to touch.
And Hans Henrik just sailed out into the sunset right there. But he will be doing an article about ThyssenKrupp later today that you get to read on our social medias and, of course, on our webpage. Again, as said, if you have questions for us, always feel free to send them to us. You can do it at FOMO@MyStockScanner.com. And guys, with the little fallout, we ran over a little on time today. But that's it for the Wednesday's MyStockScanner Live. The midweek is the perfect time to stay disciplined and stick to your 3-point playbook: quality, upside, and timing. And on Friday, as said, Liam and Hans Henrik is ready for more news, or with more news, stocks, and the Friday face-off. Until then, take care, happy investing.